Emily, market pricing has already come incredibly far. What would need to be in the minutes today to take it even farther?
Yeah, I think, what we heard from Lael Brainerd yesterday in terms of the aggressiveness in which the Fed potentially aims to implement quantitative tightening has moved rates pretty meaningfully. In fact, we've seen some astonishing volatility across the rate backdrop already. So I think a lot of hawkishness is already priced in. I think investors certainly looking for some details around the Fed's plans here. But this rate backup has been really meaningful to us and actually really, Kailey, surprising considering the fact that there hasn't really been any economic data to move the Treasury market. We've just really had a series of Fed speakers that have contributed to the velocity and the move.
Yep.
And, when we think about the bond market, usually they're sort of the smart ones in the room, and we haven't seen that reaction here. In fact, we would think Treasury yields wouldn't be moving up so fast given the potential of recession across the globe right now.
They're usually definitely the bearish ones in the room. Always the smartest. We can debate that one. Emily, maybe the Fed and maybe the Fed speakers that we've been hearing from aren't seeing what they want in the markets. Financial conditions are really important in terms of the equation that we need to think about here. Bill Dudley, Mr. Dudley, writing a piece on the Bloomberg terminal. I'm going to paraphrase. To be effective, the Fed, will have to inflict more losses on stock and bond investors than they have so far, i.e., we need to drag down financial conditions. Do you think the market is fighting the Fed here? Do you think the Fed basically wants financial conditions to come down? In fact, it is a prerequisite for doing what it wants to do, that financial conditions do come down, and we're not there yet in terms of the pricing that we're seeing.
Yeah, I think not only across equity markets where we've seen a nice rally, albeit it's really been the more defensive parts of the market that are potentially reflecting this deceleration in economic growth. But I would look in particular at high yield bond spreads and even investment grade bond spreads, which have come in really meaningfully. We see an almost perfect correlation between financial conditions and credit spreads over time, and we're not seeing that tightening that the Fed would like. Look, they're throwing the kitchen sink at forward guidance here in order to, implement those tighter financial conditions, and it's not quite working as far as it relates to the equity market and the bond market. Now, of course, that's not their primary objective. We know the Fed has a dual mandate. They want to maximize employment and they want to maintain price stability. I think equity markets are kind of another, element of that that's tertiary to their main goals, but certainly they're watching that closely and not seeing that tightening that they'd probably like to get here.
Well, Emily, also the Fed would like to engineer a soft landing in theory. I'm wondering to what extent you actually think that's possible, or if we're now faced with a kind of binary outcome, one being a recession, one being inflation getting under control.
Yeah, the challenge to the soft landing narrative is unfortunately that we don't really have any historical examples of it. If you look back at prior periods in history where inflation has spiked to this degree, it's always been followed by a recession. So unfortunately, the Fed is probably going to need to put us into a recession in order to dampen inflation from here. There is hope. We could see if inflationary pressures recede, perhaps supply chains start to fix themselves. Perhaps we see inflationary pressures come off the boil. That could certainly allow the Fed to sort of pump the brakes instead of slamming on them. But there are a few developments that aren't helping. Certainly the resurgence of COVID cases in China is contributing to continued supply chain challenges. Certainly the Russia-Ukraine conflict, which has pushed commodity prices higher, is adding insult to injury as far as the inflationary backdrop goes. So there is hope, but our kind of thoughts around a soft landing are pretty minimal right now in terms of the probability there.
Emily, generally stocks don't like recessions. We're seeing what's obviously happening in the bond market as well. But if a recession is coming, and Deutsche is now out as the first major house to talk about the fact that we are going to get a recession in 2023, how do I want to be invested? Do I want to be invested?
Yeah, it's a really interesting dynamic now. I'm a big Bloomberg listener. I listen every day when guests come on, and I'm hearing more calls for an increased backup in rates, but then I'm also hearing these calls for an increased probability of a recession into 2023. And frankly, you can't really have it both ways. right? If you think that we're heading into a recession, then you actually want to increase the duration of your bond portfolio, not decrease it, which is what we're seeing investors do right now. And that's what we'll be doing as we move closer to late cycle here. This cycle's moving rapidly. We talked about that earlier before the session began here. And we want to be starting to think about positioning here more defensively. Hey, you still might want to own equities here. On average, there's another 10 months after the yield curve inverts until the market peaks. But there's an idea here that maybe rotating into more defensive parts of the market, higher quality parts of the equity market is going to make a lot more sense here as the economic backdrop proceeds and the earnings environment becomes a little bit less impressive.